McDonald's is an interesting dividend stock that's giving passive income investors a dividend yield of 2.4% at current prices. But what's McDonald's stock really worth? What's a fair price to pay for McDonald's stock? And is it a buy for long term investors at current prices? I'll answer all of those questions in this video, doing a discounted cash flow valuation model for McDonald's stock, and also looking at the forward price to earnings valuation to determine if, at its current price, does McDonald's stock make sense for passive income investors. Let's get into the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So like I highlighted in the introduction, McDonald's offering passive income investors a dividend yield of 2.4%. Now, that's less than half of what you can get in a money market account or investing in a government bond. But with a dividend stock, you also have the potential of price increases and undervaluation. So I conducted a discounted cash flow valuation of McDonald's stock to determine what is a good price to pay. All right. So you can see this discounted valuation model is populated with many, many numbers. Some of them are actual results. Some of them are estimates for what I expect in the future. Some of them are calculations. I'll share with you precisely what each number is. Let's get started. So what we have here are the free cash flows for McDonald's stock, the 2024 number, and all the way up to the 2028 number are estimates from Wall Street analysts that are following McDonald's stock and what they believe the company is going to deliver in free cash flow over these next several years. And the source for those numbers are from ticker.com, PIKR.com. From the year 2029 to 2034, I forecast the company's free cash flow growing at a 6.3% rate. That's half the rate of increase over these next few years. And then for the longer term, starting in 2035, I'm forecasting the company's free cash flow will grow at 5%. The reason I forecast 5% is because that's the rate of increase I expect in nominal GDP through the economies that McDonald's operates. That's nominal GDP, not real GDP. Right? So the numbers underneath the free cash flows estimates are the present value of those cash flows. Because these cash flows are expected in the future, money in the future is worth less to us than money today. Every one of us would rather have $1 in our pocket today than $1 that's promised to us 5 years later. We can spend that money today if it's in our pocket today, or we can put it in the bank and let it earn a rate of interest while we save that money. So either way, we'd prefer to have money in our pocket today, whether we want to spend it or whether we want to invest it. And so if you're going to give us money in the future instead of today, it's worth less. And so we have to discount that money. Those are the numbers underneath the cash flows. They are the discounted cash flows. And the rate I use to discount McDonald's cash flows is called the weighted average cost of capital, WACC. I always spend 1 week teaching this topic to university students at the university I teach at. So if you don't understand this right away, that's okay. I take a whole week, 3-4 hours of lecture to explain this to students at the university. What the weighted average cost of capital does is it takes the company's capital sources, which can be debt and equity. In most companies, they have a mix of both, and McDonald's does have a mix of both. And it takes the cost of each source and the percentage allocated to each source, and it computes a weighted average cost of capital, which is what I've done. And I've given McDonald's an 8.52% weighted average cost of capital. I arrived at that number by taking a 6.5% cost of debt and a cost of equity of 9.2%. That's with a beta of 0.74, a risk-free rate of 4.75, a market risk premium of 6%. And since the company has $52 billion in debt and a market cap of $202 billion, I assigned the target capital structure of 25% debt and 75% equity. These numbers you see highlighted in blue, those are numbers I derived from Yahoo Finance, like the total debt, the market cap, the company's beta, the company's the company's cash and equivalents balance, and the total number of shares outstanding. So if we take the present value of all of these cash flows, we arrive at $84 billion. And then if we take the present value of the company's expected cash flow from the year 2035 to infinity, we get $236 billion. And this part here where I have a terminal value, what I did there is I could have individually forecasted cash flows between 2035 all the way out to infinity. But instead of doing that one at a time like I did with the first 10 years, there's a shortcut formula. It's called the terminal value formula, where you take the free cash flow expected 1 year ahead, divided by the weighted average cost of capital minus the long-term growth rate. And that gives you a terminal value, which essentially collects all of those cash flows expected between 2035 to infinity and brings it to one point in time. And that point in time is the year 2034. This cash flow also is in the future, right? 2034 is in the future. So we need to discount that back to today. And that's the present value of that terminal value. That's where I get the $236 billion. So combined, the value of operations is $320 billion for McDonald's, right? So to that total, we need to add its cash balance, which is $1.2 billion, subtract the debt, and we arrive at a value of equity of $269 billion for McDonald's. But we want to know the price per share, so we need to divide it by the number of shares outstanding, which are 720 million for McDonald's, and that gives us an intrinsic value per share of $374, which if we compare it to the current market price at $285, it tells us that it looks like McDonald's stock is undervalued. Also, if I look at McDonald's stock measuring by the forward price to earnings ratio, is trading at a forward PE of 21, which is near the lower end of where it's traded at all year long or the last 6 months. So whether I look at the forward PE or the discounted cash flow, it looks like McDonald's stock is indeed an undervalued dividend stock. But that doesn't mean if you buy McDonald's stock, it's guaranteed to go up in price and become $374 per share like I've calculated its value. It could remain undervalued forever. The market could go on disagreeing with my calculation for intrinsic value. This intrinsic value calculation is my own personal calculation. This doesn't mean that this is what McDonald's stock is worth, right? This is my estimate of what McDonald's stock is worth, and my estimate, according to the current market price, is different, right? The current market price suggests that stock market participants disagree with my estimate of intrinsic value, and therefore the price, there is a mismatch. So all that being said, is McDonald's stock a good buy at current prices? I think so. My calculations show me that it is undervalued, and so I rated McDonald's stock a buy, and I updated that recommendation on January 23rd. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.